Welcome to the deep dive. Let's jump right in. Inflation in 2025. You're feeling it. We're feeling it. That sense that, well, your money just doesn't go as far anymore.
Absolutely. It's not just something you read about. It hits your wallet every single day.
Right.
So our mission today really is to get practical. We've gone through SideBySide's 2025 inflation guide pretty thoroughly. And we want to pull out the strategies, the actual tactics you can use, not just understand it, but do something.
Yeah, cut through the noise, the jargon. What actually helps you? So maybe start with the basics, but let's go a bit deeper than just prices are up. What's really driving this inflation we're experiencing?
Well, fundamentally, it boils down to supply and demand, right? When you've got more money chasing, fewer goods and services.
Prices go up.
Prices go up, exactly. It's like, think of an auction. More bidders with more cash. The price of those limited items shoots up. And that decrease, that erosion in your purchasing power, that's the real sting.
More money, less stuff.
Yeah.
Classic imbalance. Now, inflation isn't exactly new. We've been here before, sort of. What can history tell us that's, relevant for today?
Oh, looking back is super important. Think about the 1970s stagflation in the U.S. That was a really rough time. High inflation and a stagnant economy.
Right, stagflation.
Yeah, and a key thing from then was how hard it was for central banks to get inflation under control once everyone just expected it to stay high. Then you had the 2008 crisis.
The financial crisis.
Yeah, and all the money pumped in afterwards. People worried about inflation then too, though it played out differently initially.
And then, bam, the pandemic. That really shifted the whole inflation conversation, didn't it?
Totally. It was like a perfect storm. Global supply chains just seized up. Governments pushed a lot of stimulus money out there.
Yeah.
And then as things reopened, demand just surged. It was, a recipe for prices to jump pretty much everywhere.
So let's fast forward. Here we are, mid-2025. What's the situation now? What are we looking at?
Okay, so the latest figures put U.S. inflation around 3.2% annually. Now that's better than the peaks we saw back in, say, 2022.
Definitely better.
But it's still, stubbornly above where we were before the pandemic. And it's not the same story everywhere. Look at emerging markets, Turkey, Argentina, Nigeria. They're still grappling with double-digit inflation.
Wow, double digits.
Yeah. And we're all feeling the swings in food and energy prices, right? That's driven by, geopolitical tensions, climate disruptions, all that stuff.
It doesn't sound like just temporary blips then.
Yeah.
More like deeper shifts happening.
That's a good way to put it.
Which really underlines why getting this bigger picture isn't just academic homework. It's essential for making smart money decisions right now.
Precisely. You need to understand the environment you're operating in. Okay, so let's make this personal. How does this 3.2%, or maybe higher for some things, actually impact your day-to-day finances?
Yeah, where does the rubber meet the road? At the grocery store. Give us some real examples of what this actually costs people.
Okay, think about your weekly groceries. If you spent, say, $100 a couple of years back, that same cartload, it might easily be $112, maybe more, today.
Ouch.
Yeah, that's a direct hit. Your dollar just buys less. Simple as that.
It's like this hidden tax eating away at things. And it's not just groceries, is it? What about savings? Money just sitting in the bank.
Yeah, this is where inflation can be really sneaky. So you've got maybe $10,000 tucked away in a standard savings account, earning practically nothing, right? Maybe 0.25% interest if you're lucky.
Right. Pretty standard.
Well, if inflation's running at 3%, you're effectively losing about $275 in real value every year. The number on your statement goes up a tiny bit, but what you can actually buy with it is shrinking.
So you're trying to save, but inflation is just undermining you behind the scenes. What about trying to grow your money? Investments. How does inflation mess with that?
It definitely complicates things for certain investments, like traditional bonds. They might pay you some interest, a yield, but if that yield isn't keeping up with inflation,
you're losing ground.
You're losing ground in real terms, negative real returns. And then think about all those rising costs we mentioned, rent, college, healthcare. They squeeze your budget, leaving less money free to actually save or invest in the first place.
Feels like you're getting squeezed from multiple directions.
Yeah.
Who tends to feel this pinch the hardest?
Well, several groups really feel it. People on fixed incomes, like a lot of retirees, their income stays the same, but costs go up. So their purchasing power just erodes unless they have inflation adjustments.
Yes. Fine.
Then you've got salaried workers. If your pay rises don't keep up with inflation, you're effectively getting a pay cut in real terms.
Right. Your paycheck buys less.
Exactly. And perhaps most significantly, low-income households. They spend a much bigger chunk of their money on essentials, food, energy, housing, and those are often the things inflating the fastest. So they're hit disproportionately hard.
Okay. It's a pretty sobering picture. We get the challenges. Let's pivot now. Let's talk solutions. What are some concrete saving strategies, things people can actually do to fight back in 2025?
Absolutely. Let's start right there with savings. This is probably a good time to look at where your cash is parked. High-yield savings accounts, certificates of deposit, CDs. You often find much better rates at online banks or credit unions.
Like, what kind of rates are we talking?
Right now, you can find annual percentage yields, APYs, in the 4% range, sometimes even a bit higher. That's way better than, the tiny interest at many traditional banks.
Okay, 4% or more. That starts to sound like you're actually keeping up, maybe even getting slightly ahead of that 3.2% inflation.
Exactly. It makes a real difference. And with CDs, there's a strategy called laddering that can be pretty smart.
Laddering, how does that work?
So instead of putting all your money in one CD, you split it up. Put some in a 6-month CD, some in a 1-year, some in a 2-year, for example.
Okay.
As each one matures, you get your money back plus interest. Then you can reinvest it at whatever the current rates are, potentially grabbing higher yields later, while still having some money become available sooner if you need it.
Ah, that's clever. So you get potentially better rates, but don't lock everything up for years.
Yeah.
What other savings tools are out there?
Well, you should definitely know about TIPS. That stands for Treasury Inflation Protected Securities. These are bonds from the U.S. Treasury. The key thing is their principal value, the amount you initially invest, actually adjusts based on the Consumer Price Index, the CPI.
So if inflation goes up?
The value of your TIPS investment goes up too. It helps preserve your purchasing power directly. Now, their starting interest rate, the yield, might be lower than regular Treasury bonds.
But they have that built-in inflation protection.
Exactly. It's specifically designed for this kind of environment.
Makes sense. Okay, what about emergency funds? That safety net everyone talks about. How should we think about that with inflation?
Good question. Because everything costs more, your safety net needs to be bigger, right?
Right.
So the advice now is often to aim for 6 to 12 months worth of your essential living expenses. Not just total expenses, but the absolute must-pays.
6 to 12 months? That's a wider range than maybe we used to hear.
Yeah, reflecting that increased cost and uncertainty. And keep that money somewhere super safe and easy to access, like those high-yield savings accounts we mentioned. Liquid, but still earning some interest.
Okay.
Oh, and a practical tip. Consider splitting that emergency fund across maybe 2 different banks. That way you maximize your FDIC insurance coverage just for extra peace of mind.
Smart. Spreading it out. Any tweaks to our regular saving habits, like the money we put away each month?
Yes, absolutely. First, automate it if you haven't already. Set up those automatic transfers from checking to savings or investments every payday. It just happens.
Set it and forget it.
Mostly. Because here's the crucial part people miss. You need to adjust how much you're saving. At least once a year, look at the inflation rate. If it was, say, 3% last year, try to increase your monthly savings contribution by about 3% too. Otherwise, even if you keep saving the same dollar amount, you're actually saving less in real terms over time.
Ah, so you have to give your savings rate its own cost of living adjustment, basically.
That's a great way to think about it. Give your future self an inflation-adjusted raise.
Love that.
Yeah.
Okay, one more key saving tip before we shift to investing.
Yes, and this one's huge. If you have high-interest debt, credit cards, personal loans, that kind of stuff, attack it aggressively. Pay it down as fast as you can. The interest rates on that debt are almost certainly much higher than the inflation rate. Letting that debt sit there while inflation is also eating away at your money, it's like a double whammy. Paying it off is often one of the best financial moves you can make.
Right. Get rid of that drain first. Makes total sense. Okay, so we've covered shoring up our savings, protecting our cash. Now, how do we actually grow our wealth?
Right.
How do we invest to beat inflation?
Okay, yeah, shifting gears to growth. Historically speaking, equity stocks have been one of the better long-term ways to hedge against inflation.
Because companies can often raise their prices.
Exactly. Good companies can often pass on rising costs to customers, protecting their profits, and hopefully boosting their stock price over time. If you look long-term, the S&P 500 has delivered average annual returns somewhere around like 10%.
Okay, 10% average. That definitely beats 3% inflation over time.
Yeah.
Are there specific types of stocks or sectors that tend to hold up better when inflation is high?
Yeah, there are. Certain sectors often show more resilience. Think about energy companies, utilities, consumer staples, things people need regardless of price. Real estate also tends to do okay.
Real estate, right.
And another angle is dividend growth stocks. These are companies that don't just pay dividends, but they have a history of increasing those dividend payouts year after year.
So you get income, and that income stream potentially grows faster than inflation.
That's the idea. It's a combination of income now and growth potential that aligns well with fighting inflation.
Okay, interesting. Dividend growth. What about tangible stuff? You mentioned real estate. Owning property isn't easy for everyone.
True. Direct ownership is a big commitment, but real assets like physical real estate or commodities can be good inflation protectors. Rents tend to rise with inflation, for example. But for easier access to real estate, you can look at REITs, real estate investment trusts.
REITs. Okay, how do they work?
They're basically companies that own and operate properties that generate income, like office buildings, apartment complexes, shopping centers. You buy shares in the REIT, just like a stock, and get exposure to that real estate market and the income it generates, often through dividends.
So like investing in real estate without being a landlord. Got it. What about commodities? We always hear about gold.
Yeah, commodities like gold, silver, oil, even agricultural products. Their prices often rise when inflation is heating up because the value of the dollar is falling relative to, well, stuff.
Right. Tangible stuff.
But buying and storing barrels of oil or bars of gold isn't practical for most people.
Definitely not.
So you can use ETFs, exchange-traded funds. There are ETFs that track broad commodity indexes, or specific ones like gold. GLD is a well-known ticker for a gold ETF. It makes investing in commodities much easier.
Okay, ETFs for commodities. So stocks, REITs, commodities. It sounds like diversification across different types of assets is pretty important.
Absolutely key. Don't put all your eggs in one basket, especially not now.
What about newer things like crypto? People talk about Bitcoin as digital gold. Does that hold water as an inflation hedge?
Crypto. Yeah, you hear that digital gold argument for Bitcoin. The idea is it's a scarce asset outside the traditional system, but it is incredibly volatile, its price swings are huge, and it doesn't always move in relation to inflation the way you might expect. Plus, there's still a lot of regulatory uncertainty.
So approach with caution.
Extreme caution. If you're interested, maybe consider allocating only a very small percentage of your speculative portfolio, like maybe 1% to 5% maximum, and be fully prepared for the possibility of losing a significant chunk of that. It's not a reliable hedge in the way TPS or maybe even stocks can be.
Got it. High risk, high volatility. What about looking outside the U.S., investing internationally?
Yeah, that's another diversification angle. Investing in foreign stocks or international funds can help. If U.S. inflation is high, but maybe it's lower elsewhere, or if other economies are growing faster.
Like where?
Well, historically, emerging markets sometimes offer higher growth potential, though also higher risk. Places like India or Brazil are often mentioned, but it depends on the specific economic conditions at the time. It diversifies your economic exposure.
Spreading the risk geographically. Makes sense. Any other maybe less common investment ideas for inflation?
For folks with a higher risk tolerance and maybe more capital, there are alternative investments. Things like peer-to-peer lending, collectibles, think fine art, wine, even investing in farmland.
Farmland. Interesting.
Yeah, it's a real asset, produces food, which costs tend to rise with inflation. But these alternatives are usually less liquid, harder to sell quickly, and they often require specialized knowledge. So not for everyone, but they exist.
Okay, a pretty wide menu of investment options then. Now let's shift gears slightly. Let's talk about mistakes. What are some common pitfalls or myths about inflation people should avoid?
Good topic. A big one is the old saying, cash is king.
You hear that all the time in uncertain markets.
Right. And look, having cash for emergencies is absolutely vital. We just talked about beefing up that emergency fund, but hoarding too much cash beyond your emergency needs for long periods, that's a guaranteed way to lose purchasing power when inflation is running high.
So cash is king for liquidity, but maybe not for long-term wealth preservation.
Exactly. Keep enough for safety, but put the rest to work in assets that have a chance to grow faster than inflation. Don't let it just sit there eroding.
Okay. Debunked myth, #1. What's another one?
How about gold? The idea that gold is always a safe haven during inflation?
All right. Seems logical. Dollar down, gold up.
It often works that way, but not always. Gold performance can be patchy. It might do well in some inflationary periods, but it can lag in others, especially if interest rates are rising sharply, making interest-bearing assets more attractive. And it definitely doesn't do well in deflationary times.
So it's not a magic bullet.
No, it can be a useful part of a diversified portfolio, a piece of the puzzle. But don't bet the farm on gold alone, solving all your inflation woes.
Diversification again.
So,
Okay, what about practical mistakes people make, not just myths?
a classic mistake is trying to time the market, thinking you can predict exactly when inflation will peak or when stocks will bottom out.
Good luck with that.
Exactly. It's nearly impossible. People who try often end up sitting on the sidelines, missing out on potential gains, or buying high and selling low out of fear.
So what's the alternative to market timing?
A much less stressful and often more effective approach is dollar-cost averaging.
Right, investing a set amount regularly.
Yeah. You'd invest the same amount of money, say $200 every month or every paycheck, into your chosen investment, regardless of whether the market is up or down. When prices are high, you buy fewer shares. When prices are low, your fixed amount buys more shares. It averages out your purchase price over time and takes emotion out of the equation.
Smooths out the bumps. Good strategy.
Yeah.
Any other pitfalls to avoid?
Yeah, be really careful about taking on too much debt, especially variable rate debt, when inflation is high.
Why is that?
Because high inflation often leads central banks to raise interest rates to cool things down. If you have debt with a rate that can go up, like some mortgages or credit cards, your payments could increase significantly, putting a major strain on your budget.
Ouch. So lock in fixed rates if you can.
Definitely. If you have variable rate debt, explore refinancing into a fixed rate loan if possible, especially if you think rates might climb further. Locking in your payment provides stability.
Good advice. Okay, let's zoom back into the present moment. Mid-2025. What are some key financial trends happening right now that relate to all this inflation talk?
Well, one thing we're seeing is this sort of cautious dance by central banks, like the Fed here in the US or the ECB in Europe. There's talk about potentially lowering interest rates from their peaks, but they're watching inflation data like hawks. They don't want to cut too soon and let inflation flare up again.
So still walking a tightrope.
Very much so. Another interesting trend is the role of AI, artificial intelligence, in personal finance.
AI, how does that connect to inflation?
Well, robo-advisors, those automated investment platforms like Betterment or Wealthfront, are getting smarter. They're using algorithms that specifically factor in inflation data and forecasts to automatically adjust investment portfolios for their clients, trying to keep them positioned appropriately.
Huh. So the robots are trying to inflation-proof our portfolios for us.
Kind of, yeah. And another big theme is green energy investing. ESG, environmental, social, governance investing continues to gain traction. Things like clean energy stocks, funds focused on sustainability. They're getting a boost from government incentives and just growing awareness.
Interesting. So the financial landscape keeps shifting.
Yeah.
What are some immediate takeaways or actions our listeners can focus on right now to navigate this?
Okay, number one, stay informed. You don't have to be an economist, but, subscribe to a couple of good financial newsletters. Keep an eye on the CPI reports when they come out. Follow some trusted experts. Knowledge is power here.
Right. Know what's happening.
Number two, check your portfolio balance. At least once a year, look at your investments. Has the mix drifted? Do you have way more in stocks now than you planned because they grew? Rebalance back to your target allocation, the mix of stocks, bonds, etc., that matches your risk tolerance and goals, especially important with inflation shifting things.
Keep things aligned. Makes sense.
And third, keep learning, never stop. Read a classic investment book, maybe like The Intelligent Investor, or check out some free online courses on finance from places like Coursera. The more you understand, the more confident you'll be.
Continuous learning. Great advice. Now, we should probably be realistic too. Are there limits to these strategies? Can things still go wrong?
Oh, absolutely. We have to be honest about that. No strategy is guaranteed to beat inflation 100% of the time. Even things like TPS can sometimes underperform expectations depending on market conditions.
So no silver bullets.
No silver bullets. And then there's just uncertainty. The world is unpredictable. Major unforeseen events, people call them black swan events, can pop up and completely derail economic forecasts and investment plans. Pandemics, wars, natural disasters.
Right. The unexpected can always happen. Any other challenges we should acknowledge?
Yeah, a couple important ones. One is access.
Yeah.
Let's face it, not everyone can easily open a high-yield savings account or invest in a diversified portfolio. There are real barriers for some people, and that inequality matters.
That's a crucial point. Access isn't equal.
And the other big one is us, humans, our own psychology. Fear makes us sell at the bottom. Greed makes us chase hot stocks at the peak. We fall for misinformation. These behavioral biases can wreck even the smartest financial plan.
So we can be our own worst enemy sometimes.
Often, yeah. Acknowledging these limitations, that strategies aren't foolproof, uncertainty exists, access is unequal, and our brains play tricks on us, it actually makes for a more realistic and ultimately more resilient approach to managing your money.
Important perspective. Okay, so let's try and wrap this up. What's the main message you want people to take away from this deep dive on inflation in coming 25?
The main message is, yes, inflation is a challenge. It's real. It affects you. But it's not an unbeatable force. You can take control. By using these smart saving strategies, by investing thoughtfully,
You can fight back?
you can fight back. You, the listener, can take meaningful steps to protect your money and hopefully grow it over time.
And really, this isn't just about dollars and cents on a spreadsheet, is it?
Not at all. Ultimately, this is about preserving your freedom, your security. It's about making sure you can still afford the things that matter to you, achieve your long-term goals, buying a house, retiring comfortably, supporting your family, even when prices are rising.
So what's the final word for everyone listening? What should they do next?
Start now. Even small steps count. Pick one thing from today, maybe opening that high-yield savings account or setting up automatic transfers or researching a low-cost index fund. Just start. Be consistent. And be adaptable. Keep learning and adjust as things change. Remember, you're the captain of your financial ship navigating these inflationary waters.
Well said. And on that note, here's something maybe to think about after listening. We've talked a lot about financial strategies, right? Savings, investments. But what about the non-financial things you could do? Things like negotiating a raise at work, learning new skills to boost your earning potential, maybe even finding creative ways to reduce your spending without sacrificing your quality of life. How can those complement the financial tactics we discussed today to help you weather the inflation storm? Something to chew on. Thanks for joining us on the Deep Dive.